Good morning, everybody. Happy Monday, coming from Boston, coming to you live. Great to be with all of you today. It's June 17, 2024. My name is Bob Lang, and it's great to be with all of you today for this morning's Daily Bites. We bring this to you on every Monday and Thursday, roughly around 8:30, 8:45 in the morning. Talk a little bit about the markets, the economy, anything that's might have happened, anything that's going to be happening in the next couple of days to give us a little bit of an edge. So I mentioned coming to you live from Boston. Tomorrow I will be heading out to California, and the next couple of Daily Bites, if I'm able to wake up in time, will be from California, would be on Thursday and Monday of next week. So be on the lookout for that. Hopefully I'll be able to, again, hopefully be able to make it up at and get to you at 5:30 in the morning, West Coast time. So hope everybody, all the dads had a great Father's Day, and all the pseudo dads also had a great Father's Day yesterday. I had a wonderful day yesterday as well. We have a short trading week. Why is that? Because Wednesday the markets are closed in observance of Juneteenth. It's the newer holiday that we that was passed a couple of years ago, and the New York Stock Exchange and the Nasdaq have decided to observe that holiday with a day of no trading. So there will be no trading on Wednesday. So we have a 4-day week of trading, and then of course Friday builds up to Friday, which is an important day as well. And why is that? It's because it is a triple witching expiration day on June 21st. That's Friday, and what that means is we have options, index options, and options and futures all expiring on the same day, so around the same time. Some at the beginning of the trading day, some in the middle of the day, and most of them at the end of the day. This week also we have a roll into the September futures, and some of you may notice the differential has grown dramatically between the futures and the cash, right? So the cash closed on Friday, S&P cash, at 54.31. Currently, futures are about 54.97, which is about well, it's down about 4.75. So if we equate where the futures were this morning, at the flat line, it would be about 55.02 versus 54.31. So that is about a 70-point differential. Now, why is there such a huge separation between the futures, September futures, and the cash? And that is due to the fact that interest rates are elevated here on the short end of the curve, and also the long end of the curve. So that's the explanation for that. And when interest rates start coming down, you will notice the differential between the futures and the cash starting to narrow going forward. So hopefully, maybe down the road we're going to see some interest rate cuts, maybe at least one this year, perhaps a few next year in 2025. We had the Fed meeting last week, and they talked about wanting to continue to wait and be patient and watching the data. And there's certainly nothing wrong with that. And, they made some mistakes by not attacking inflation early enough. So now they don't want to make a mistake by trying to lift the policy too soon. Now, the problem here is very similar to what we had earlier in 2024, where the market has started to price in rate cuts way ahead of the Fed. Right, and that's what markets do. Markets speculate. They look at the future, and they try to estimate and guesstimate what is going to happen, and they start pricing those things in and start making bets on those events happening. But of course, earlier this year, there was the anticipation that there could be 5, 6, maybe even 7 rate cuts in 2024 and into 2025. That was way too ambitious by the markets, and we saw a lot of those potential or estimated rate cuts by the market pulled off the table. And when that all happened, we saw markets swoon to the downside and get anybody who was into the markets because of that reason. They got hammered. Now here we are. We're at all-time highs. Yet still the market's only pricing in maybe 2, possibly 3 rate cuts at the end of 2024. Still a little bit ahead of what the Fed is looking for. The Fed is probably looking for one rate cut. Now, certainly if the data tells us that inflation is starting to recede at a much faster rate. We did see a good CPI number on Wednesday, and even a better PPI number on Thursday, which came in at 0. So if we get a couple of more readings like that, I think the Fed is going to start entering rate cuts into the conversation down the road. So we only have 4 more meetings left in 2024. We have a July meeting, a September meeting, a November meeting, and then a December meeting. Now, of course, don't forget, August is a big month too, because that is when Chair Powell will be giving the keynote speech, I believe, at Jackson Hole. We often have some sort of movement with the markets and interest rates during that meeting. It's been happening since for the past 20 years. So don't expect anything to be benign here. A couple of years ago, even when Chair Powell came in and said he was adamant about fighting inflation, the markets went into a tailspin and into a nosedive and into a bear market in 2022. So let's take a look at the markets here for a little bit, and we can see. I want to show you a couple of charts. First of all, something I wrote about last week and I wrote about this morning for thestreet.com, for Street Pro Portfolio. Read about it this morning. Interest rates. Now, this is the long end of the curve. This is the 10-year, kind of medium to long-term end of the curve. And we can see that interest rates on the long end of the curve has really started to come down, right? And that would be a welcome sight here, right? That would we see that arc is turning down. We've made lower highs and lower lows on the rates, which means that bonds have started to rally. Yet we don't have the accompanied rise in small cap stock, which is the IWM, right? And normally we see when interest rates come down, small cap stocks start rising, but we don't have that combination right now. And why is that? It's probably because the drop in interest rates and the rise in bonds right now is due to the fact that the market is seeing a slowdown in the economy. And certainly from the really hot GDP number that we had in Q4 and was sliding in Q1 and possibly even lower or about the same in Q2, estimates are, let's see what the estimates are for that. Let me show you here. See here. GDP now. You can see, hold on, there we go. So 3.1, it's actually bounced up. It was coming down about 2%. So after the jobs report and after the data last week, we're up to 3.1, but a couple of other ones like the New York Fed and also the St. Louis Fed see lower GDP, about 2% estimates, so forth. So, but again, this is interesting about the 10-year yield, and it simply means that the market is expecting that the economy is slowing down over here, and the long end of the curve is people who are buying bonds are trying to force the Fed to cut interest rates, because what's happening here, basically the spread between the Fed funds and the 10-year, the spread between the 2-year and the 10-year is started to widen again, right? And we remember we had that situation earlier this year where we had a big, huge spread between the 10-year and that, well, we can see it back over here with it's 3.8%, and we had the Fed funds future still at 5.25. We haven't had a move in the Fed funds future since July of 2023. So it's basically stayed the same from 5.25 to 5.5% for almost a year now. It'll be the year at the end of July. We'll have 6 Fed speakers here in the next 2 days, 1 today and then 5 tomorrow. And I don't expect that they're going to say too much different from what they did last week from the meeting, but we could certainly see some, perhaps they're going to, a little bit of thawing in the ice of monetary policy here. Perhaps they're going to say something up to the notion of, well, look, the data looked good last week, but we need to see 1 or 2 more reports like that to figure that the fighting of inflation is really starting to work here right now. Last chart I want to show you here is, let's see. Okay, there we go. All right. Here's that divergence I want to show you here. And what is this? This is the S&P 500, which is in red. thin red line, and the Russell 2000 IWM. And you can see that if you look at past history, there's often very, very strong correlation. What does that mean? Correlation means that when they both move in tandem, they both move together. Now, of course, it's not perfect, right? But we don't often see these divergences like we're seeing right now. And look at the red line is moving up to new all-time highs, which is the S&P 500. The black line, which is the IWM, is moving down. We said this huge divergence right here. And it doesn't last, again, for too long. And again, if you look back over here, you don't see much of a divergence at all, certainly since 2023. We had one over here, and that resolved itself. The Russell 2000 went up too much, and then the S&P 500, and it came down. So we may get something like that happening very, very soon. Certainly, if rates decide to turn right back up again, we're going to see the Russell 2000 continue to make lower highs and lower lows, as it's shown in the chart, and we may see the S&P 500 also follow. And why not? Certainly, if interest rates start to rise again, start to head back up again, that's not positive for equities. And certainly with the S&P 500 sitting on currently up about 16% year to date, the S&P 500 has been strong. The Nasdaq almost up about 18% for the year in 2024. That may take a hit as well too. So something to watch out for. Again, this divergence is not anything that very many people have been talking about, especially graphically here, but I want to show it to you in a picture here. To really, it says a lot about about the divergence we've had in the markets. We've also had the S&P 500 making strong moves up, but we've had very poor breadth, right? And the breadth often is led by the Russell 2000 stocks, of course, on an equal weighted basis. But the oscillators are pretty mildly oversold right now, right? So we don't have a market on the price action that is oversold. It's mildly overbought, but then we have the oscillators oversold. So we have a lot of divergences going on right now. So not just this one, we also have the put call ratio as well too. So things to watch out for, right? There are tripwires around every corner. You just have to be careful. Volatility is still rather low, and we could certainly have a pop up in volatility, much like we had last week, and scare everybody out of the markets. But then, the trend still continues to be up until further notice. So I think it's going to be it, everyone. Have a great day. Not a whole heck of a lot on earnings this week. We have Lennar and KB Home this week. Today, Lennar, tomorrow, KB Home. We have Accenture, Kroger coming out on Thursday morning before the market opens, CarMax before the market opens on Friday. So we're in that phase of earnings right now where just a few small important companies. Later this month we'll have FedEx and Nike coming out as well too. We do have Darden coming out on Thursday morning, so that'll be interesting to see if the consumers are still going out to eat. So I think it's going to be it, everyone. Have a great day. Have a great couple of days here. I will be back again, hopefully, from California on Thursday morning. And I wish everybody a great trading day, and I'll see you guys all on Thursday. Have a great day. Bye.
Just like everything else, those were crazy dreams just kind of came away.